Hey everyone, welcome back to the Wealth Preservation Podcast. We are very excited for episode 2 with Henrik and Finoa over in Berlin. Henrik, how's it going?
It's very good. How about you, Mark and Josh?
We're doing great here, and we're in Eastern Tennessee. It's nice and sunny. Spring's on its way out, so it's Friday, like you mentioned. So we're in a good mood. It's been a busy week, so we're ready to talk about some cryptocurrency.
Looking forward to it.
Yeah. And so, specifically, how because we covered this in the first episode, and we'll do like a quick recap. But you also you started your business, and you've scaled from basically you and your roommate to 120 employees, 135 employees in a span of 4 years. Right. And I don't think that you scale that way on accident, right? There's probably some organization, which I could probably learn from myself in that process. So we're really, really excited to dive into that as well. So
happy to.
Yeah, because and for all of us and for the people listening to our podcast, that's always, sometimes growing is just as bad as not growing, right? Because it can create its own set of problems. So yeah, it's a fun topic to get into because it's a whole other can of worms, right? When you're trying to figure out how do I corral 120 employees and meetings and technology and I'll stay on the same page and lead and all that kind of stuff. So it's fun.
Yeah, it's a great learning curve. Yeah, that's for sure. You learn a lot of stuff that you maybe even do next time a bit differently, right?
Right. Yeah.
I feel like not growing, you can always like rely on like oh well, it just didn't take off, the market wasn't ready for us, we're just too innovative, and growing too fast and failing is like, well, I just suck at managing a large organization. So that's why that failed.
That's the risk to it. Yeah.
The market wanted me too much and I couldn't handle it. So perfect. Well, real quick, can you give everyone just a quick snapshot of Finoa, what you guys do and where you're based out of?
Yeah, happy to. So Finoa is based in Berlin, Germany, and we are providing crypto financial services to institutions and institutional investors. And we have as our core product crypto custody for around 150 different cryptocurrencies and tokens. We provide our crypto custody platform, and on top of that, we have built also what we call in-custody staking. So staking, a second product, very much growing in the crypto and blockchain environment as per the proof of stake mechanism that a lot of protocols are built on. And we allow our customers to delegate their assets to create yield based on the staking mechanism. And that is just something, if you invest in crypto and if your a protocol that you invest in is based on proof of stake, that's just something that you have to participate in to not basically be subject to inflation. And on top of that, what are we building out as Finoa? As I said, we are a regulated financial player here in Germany under the German Banking Supervisory Board. And at the end, what we want to build is a curated access for our institutional customers to enter Web3. And what I mean with Web3 is anything in decentralized finance, so the buzzword DeFi, which is decentralized lending, it's liquidity pools, it's anything where you can create yield in a decentralized context. And it's everything beyond just as brokerage, trading, basically everything in an institutional journey. When you enter crypto and when you deal with crypto, we provide that access as a regulated institutional player.
So awesome. That's probably like 25 episodes right there that we could talk about decentralized lending and all of that. But kind of can you take maybe like kind of how the industry is right now and like, current assets, and then kind of draw a parallel to what you guys do in crypto. So kind of, like, hey, this is what big banks and big institutional are looking for and what they do. This is how we do it in crypto, and kind of draw a parallel because it's kind of a new thing, right? So people always want to connect things to the, what they know to what's new. So can you kind of make a little bit of a parallel there?
No, absolutely happy to. I mean, when you look at crypto, crypto is the catch-all phrase for a lot of different assets, right? And
correct, yeah.
I mean, first and foremost, it's still very much Bitcoin driven, right? That's the most prominent cryptocurrency. But what we've seen over the last years is a lot of new, let's say, token economics kind of evolving. First and foremost is the Ethereum ecosystem, so second largest cryptocurrency, which allows as a platform to build different use cases on top of it with their own token economics, with their own token being run on that platform. And what we focus on is giving the institutional investors like venture capital, asset managers, family offices, private equity, hedge funds, who have crypto in their portfolio, to give them a safe haven to store and manage their assets and to grow their assets. What you see at the same time, what we always separate a bit from what we call crypto, so the crypto natives, maybe so to speak, is everything that is tokenization of assets, right? So you see that this technology that Bitcoin brought to market with blockchain and decentralized consensus mechanisms also allows to kind of bring traditional financial assets on new rails to the market, basically on the same technology, also in a token basis, but that token doesn't represent a cryptocurrency, but it maybe represents equity, debt, collectibles, any financial asset, any commodity, basically, is potentially being able to be traded as digital value on chain. And when you see a bit the separation of the market, you saw the incumbents, the traditional banks at the beginning, very much focused on the latter. So kind of seeing, okay, is there a way for my current infrastructure to run this on a different tech stack, more efficiently, faster, more globally connected? So they were very much focusing on these security token environments, or let's say traditional asset tokenized environments, whereas we, the crypto native kind of players in industry, really went into, let's say, this crypto, decentralized finance, cryptocurrencies like Bitcoin use cases, because that was just much more interesting for us. And what you see lately is that what hasn't really taken off, even though I would have expected it to really start being much more of a topic already in now 2022, is this entire tokenization of traditional assets. That's still dragging. It has a lot of reasons because of the laws, because of the regulation in different jurisdictions. It's just, there's a lot of plans, but they don't really get to market. So you see suddenly the incumbents also looking more at the crypto native, right? For example, going after Bitcoin, going after the DeFi use cases itself, even though at a much slower pace maybe as the crypto native players do it. But you see a bit of a convergence of the crypto native industry and then also the incumbents from the traditional financial system.
Yeah. So, I mean, again, geez, that's another 10 episodes you just talked about right there. So, when you're, well, I'll talk about the tech stack first. We're in the financial services business, and, a lot of, let's just take Schwab or some of these other big companies. I mean, their tech stack is still written on, I think it's like Cobalt or something from the late 70s, or mid 80s, right? Is where their tech stack is written on. So how much of a challenge is it to take, obviously cryptocurrency or, the crypto stack, right, and translate that into financial institutions that are running on just antiquated technology? I mean, it's antiquated, maybe not, that's a maybe a kind word, right? I mean, they're so far behind the power curve on that side.
That's a very good point, and I think that's also kind of a silver bullet that hasn't entirely been solved just yet, right? Because which is in a sense great for us as a crypto native player, because it allows us to really grow into the space, collect a lot of customers, because the incumbents can't really serve that growing need with their current tech stack.
Absolutely.
But obviously you see a lot of work being done at the moment as well to kind of integrate the two worlds, right? So somehow building the right bridges and the middle layers, in a sense, that help let's say the traditional financial institutions on their traditional tech stack to then serve through the known infrastructure of their customers, or the known platforms that they serve their customers with, that new asset class, which is running on a completely different tech stack, right? But to be very frank, I haven't seen any traditional player doing that very successfully just yet. And that's also one of the reasons why Coinbase, for example, in the US is so successful, right? And has grown so fast and being a multi-billion-dollar public company by now, right? And the other question is then, how much need is there still in the market for, let's say, the large institutional investors to actually ask that service from their traditional financial services provider, if they now also find fantastic organizations, crypto native, with probably much cheaper production of those services towards the customer, because they have built that tech stack from the beginning natively in that new environment. And
right.
That's what I'm currently observing as
well. Yeah. Well, as Mark and I always joke, like there's still companies we have to fax things to them. So that just drives us bonkers. Yeah. We still have to use a fax machine, right? So that's if there's one industry you want to disrupt, if you could disrupt the life insurance industry, Mark and I would greatly appreciate that, because that is a
crypto life
company
insurance
where they still require faxed in wet signatures. I mean, it's mind blowing how terrible it's mind numbing. So
yes,
if you want to work on that one next, Henrik, Mark and I will support you 100%.
Where do I invest?
Let's take that offline.
Which because you said something in the beginning too, and I wanted to point this out. So you mentioned staking assets as well. Can you tell the listeners real quick the difference between, like, just owning crypto versus staking your crypto assets?
Yeah, I mean, when you decide to directly invest into crypto, right, not go through an exchange traded product or like an ETF built on crypto, but you actually go directly into the investment. You have different cryptocurrencies that you can invest in, from the most prominent, as I said, Bitcoin, and then the more new and upcoming ones, for example, like Bitcoin initially was built on a decentralized consensus mechanism, which is, I don't want to go too much into detail, but it's basically a way in a decentralized system run across the globe on different computers, easily speaking, to find consensus. What is the latest state of this, let's say, database, right? How do we verify what's the status of this database? And this proof of work mechanism for Bitcoin, you see all the negative press about it as well. It's very resource heavy. It uses a lot of energy, uses a lot of electricity, because you need to run complex mathematical riddles that you have to solve, basically. And then you are able to kind of verify and prove a transaction and verify this latest state of the database, very easily explained. Proof of stake, on the other hand, is it's around for like maybe 4-5 years only, whereas Bitcoin is now 12 years old. It's a much resource lighter version to find consensus. It basically gives you as a token holder the chance to participate in the network, not by using a lot of let's say energy and solving a mathematical riddle, but by rather stake your assets and put your assets at stake. That's a bit where this is coming from. So you kind of give your assets to the network. You trust the network to hold these assets. And with that stake that you give the network, you give the network at the end also the ability to, again, validate, verify the latest state, and with that find consensus in a decentralized network. And in return, because you put your assets at stake, and it already, as this word entails, includes a bit of risk. And that's maybe another thing I don't want to go too much into detail now, because that becomes very complex either. But for that risk that you take, for the stake or the assets that you put at stake, you get a reward in return, and you grow your asset base. And with that, you just have to make a bit of a decision as well as an investor into crypto. Is, first of all, what's the portfolio of crypto assets that you want to build? And that's just the same as in the traditional financial system. You also need to you always have to have this portfolio thought, right? Like, how do I diversify my risk? Same is true in crypto. If you just invest in Bitcoin, you might have a quite good let's say coverage of the market, because Bitcoin is still so heavy, but it's by no means already a healthy crypto portfolio, right? You should build a portfolio that entails different token economics, that entails different proof or consensus mechanisms, like proof of work, like proof of stake. And if you invest then in a proof of stake protocol, you should also make sure that you participate in that staking mechanism, because otherwise you're missing out on yield. And that's basically what we as a company provide with our platform to institutional investors. So we give them the opportunity to hold different kinds of crypto assets. As I said, around 150 different tokens, of which I think 11 or so are proof of stake protocols as of today. And for those, we then also give them the chance to participate in that staking mechanism and create yield. And so it becomes a very interesting investment use case, because yield, I think we talked about it in the first episode as well. I mean, everyone is in search for yield. Let's see if now with raising inflation and maybe raising interest rates, suddenly cash deposits in the future will create interest again. That's going to be an interesting dynamics in general. But as of today, very little yield in any risk-free environment at the moment. So you need to find yield-generating opportunities to not inflate or have your portfolio basically be subject to inflation.
Yeah. Which real quick, this would probably be a good time to interject just a compliance housekeeping item, which is, Josh and I, obviously as wealth managers, we do not offer this, right? And so just, if you're listening to this and you're like, oh my gosh, this sounds amazing, this is informational only. And at the time of this recording, if you call us and say like, hey, I want what that guy's talking about, we're going to say like, sweet, go find someone who does what that guy talks about on an investment side. And there are, I've talked to a few, there are some, crypto advisors out there that are amazing. We're just currently not in that space. So quick housekeeping item, our compliance officer will very much so appreciate that quick.
Yeah. And that goes back to the earlier conversation about, because the current system, right, with all the brokerage houses and everything being on such antiquated tech, I mean, it's been, I don't know how long it'll take them to integrate this stuff at any sort of really tangible level so that it can. So anyways, we're excited about what you're doing, because what you're doing is making it what all of us that are kind of in the investment world or the asset management world have been looking for a long time, right? We want to be able to offer things to our clients or even for ourselves, but be able to use it as in the same mechanisms that we currently offer for our clients, right? And that's what you're kind of trying to bridge that gap currently, if I'm seeing that correctly, in a very simple way.
Yeah. And for anyone who didn't listen to our first episode, I definitely go back and check that out, because we did cover Henrik's experience of, man, this is just such a odd way of investing in crypto. This is so seems shady. And then he went to the big institutions and he's like, you're doing the same shady stuff I am. Like, it's not shady. It just seems very this is really how we do this. There's got to be a better way.
So Henrik, just from my simple brain, do you offer clients the ability to say they want to collateralize something and they're going to go, they're going to go buy XYZ asset, right? And they have to prove a proof of funds. Is that kind of part of what Finoa does? Is you're able to see that at an institutional level, see where it's held, see that the client actually owns that. So when they when someone's like, oh hey, do you own, do you have $10 million to go buy this property? Like, oh yeah, I have $3 million in Ethereum or Bitcoin or whatever the token is, to help prove that up. And is that kind of that clearing mechanism to show that?
Well, I mean, that's actually an interesting point. That's not what we focus on or what we work at. So we don't, let's say, help them to collateralize a certain stake that they have in crypto or so and leverage that for any other financial investment or such. We also don't tokenize it. So what we really only focus on is providing infrastructure and the platform at the end to easily manage crypto assets, the direct investments. So really that the investor holds himself. We safeguard higher, let's say, security infrastructure behind those tokens in our platform, so that the user really only focuses on, okay, what do I do with my assets? How do I grow my assets? And it's always in this direct exposure to the respective protocol. So if the user holds Bitcoin with us, he holds it directly on chain, and he holds it just with Finoa as a service provider. And we kind of facilitate the management of such.
Yeah, gotcha. Okay. So I mean, and then just out of curiosity, how do you guys charge fees on that? This is me, just my own personal curiosity. How do you guys make money on that, right? And that's just out of curiosity.
Yeah, I mean, just as in the traditional financial system, you have custodians, or in the traditional financial system, there's global custodians like BNY, State Street, etc., who are at the end charging a percentage fee on the assets that they hold under custody, right? And it's very similar in crypto. The overall pricing scheme is still it's very different. I mean, that's basically based on a different risk model that those assets entail, because a global custodian, it's very hard to lose actual, let's say, share into a publicly traded company, right? Often it's still replicated in a piece of paper, Then
Sure.
one piece of paper represents, I don't know, millions of shares, but still there's still this physical aspect of bearer bonds, for example, as well entailed, and those are stored with global custodians. In crypto, the risk model is a bit different because those assets are fully digital. They are fully transferable. They're permissionless, so you don't have a closed system of banks or so that just go forth and back and moving, for example, financial assets left and right. You have also a complete open system. Everyone can set up a wallet on your computer and your smartphone, and you can move assets there on chain, right? So that's a different risk model, and that's why we also charge, let's say, higher percentage fees on the assets than in the traditional.
Absolutely. Yeah.
On top of that, what I just mentioned, whenever a customer is able to create additional yield with us, for example, through participating in the staking mechanism, additional yield for the customer also means additional income for us, right? So we take a charge on that fee and on those rewards, the yield that the customer receives, and we charge that basically as a facilitation fee, a transaction fee, however you want to coin that. And with that, the more our customers earn, the more also we as a business model profit from that. So it's kind of a win-win situation.
Gotcha. And so just out of curiosity, like, do you guys get paid in that asset or that coin or that stake, or do you guys clear everything back to local currency?
That's a very good point. So it's a mix actually. So we have some customers, use cases, integrations where we literally do the entire process basically in that respective currency. So we get also our services get paid in that currency. Obviously, I think that could be a good follow-on question. I still pay my people in euros, so in cash. Although I had a very interesting conversation yesterday, actually, how that is also changing. Also, how there's more and more demand from our team as well to kind of learn. Hey, is there a way also to get paid in a stable coin, which is packed to the dollar, packed to the euro, but I can, with that stable coin, directly access some DeFi use cases, and so I see that coming up more and more. And then we have just customers that still pay in cash, which is obviously not as capital efficient because you have, for example, your assets stored with us, you have them being staked, and with that, there's sometimes also a bit of a fixed term lockup where those assets then are not liquid, so they're illiquid, and then they pay their the fees in cash. So that's not fully capital efficient as you would hope it would be. That's why some customers literally say, "Hey, I do everything in crypto."
Gotcha. Okay, no, that's very interesting because again, that's bridging that system from the old system to the new system and trying to formulate that mechanism about, when do you fully make that crossover, right? When is it like, hey, we're doing away with the old and the new and bridging that? And, I would think that you guys, just as a custodian are taking on risk too, because, some of the volatility within some of the certain, different coin markets, if you get paid in a certain coin and it loses, you guys are taking a lot of stake on there too, also, or a lot of risk on there too, also. So you got to get paid for it.
Yeah, exactly. So there's also a bit of a treasury strategy behind it, right? Also a risk and hedging strategy behind it. How much crypto treasury we want to take on the balance sheet, right? And and that's certainly something where in the bull market things are much more fun than in the last 6 months when we saw quite some volatility. Also a bit of a downward stream from the all-time highs that we've seen end of last year. But still, I mean, we believe in the crypto ecosystem. If we also have some treasury, and we have maybe seen a bit of a market hit, then we also have a deliberate decision to kind of buy, keep and hold those assets. And in the long run, I'm always bullish on crypto, because if you zoom a bit out, even this kind of setback or consolidation that we saw over the last 6 months in the total scheme of crypto and the market development since, let's say, 2011 or so, it's just a small dent on the overall growth trajectory. So that always helps me as well to kind of stay easy and keep cool when the market does a setback of 5-10% a day.
Yeah, absolutely.
Now,
I mean, that's just Go ahead, go ahead.
I was going to say, because you obviously, proof of concept, all that, like, you're growing your, like Finoa really took off. Kind of going to the business side of things, was what you're doing now always the intention of, like, when you guys set out to do this? Were you guys always like, hey, we're gonna work on the institutional level, we're gonna be doing, or what, did something happen where you were like, okay, I think we need to, with that regulation, we need to shift gears?
Well, obviously, it's like the very, very early idea that we had that started ideating 2018, and we incorporated 2019. And obviously, there was quite some pivoting in the process, and we changed a bit the let's say, focus, the priorities, and what's the first product that we're going to go to market with. But one thing that always stayed around was basically three pillars. We said we want to provide a secure access to crypto, because that was what me personally was always my biggest concern back in the day when I was playing with crypto in 2016, 17, or started to invest. And second was, we wanted to build this out of a trusted jurisdiction, because often when I looked at the different platforms, exchanges that I was using, I couldn't even find an imprint or even find out where is that exchange based, where's the team sitting, is there, if my assets were to disappear, who would I actually like reach out to? Where are they? What's the jurisdiction governing this? So that was the second piece, and we are still operating and planning to keep on operating out of Germany. And then the third one was, we always expected regulation to come in. That was kind of clear. I mean, I was working from a consulting side with financial services providers and institutions in the past, and it was just clear for me that market will be regulated. That was in 2018 already. And what I didn't expect that it would happen so quickly. So especially the German banking regulator, basically the German SEC counterpart, they already, 1st of January 2020, introduced quite a substantial and progressive crypto framework, which declared crypto assets as financial instruments. They're just under the German Banking Act like any other financial instrument, and with that, our business model was falling under the regulation and supervision of the supervisory board, and that obviously came earlier than I had anticipated. I would have thought maybe another year or two would pass until that happens. Looking back now, I mean, it created obviously quite some additional overhead of work and setting up the right compliance structures, etc. in the organization, but what I really see is how that pays off as well towards the customers, because I mean, our core business is trust, and especially institutional investors, working with a regulated counterparty is one of the key drivers as well to keep and maintain the trust, because that's just how the traditional financial system works. Regulation has been seen also to have an eye on the trustworthiness of each and every player in the ecosystem that is upholding his compliance against the regulatory framework. And for us, that really was also a kickstarter of maturity as an organization, which maybe otherwise would have taken us a bit longer to reach. And in that sense, those three pillars, security, trusted jurisdiction, and we want to be regulated sooner or later, those all still exist since the early days. Obviously, the actual products that we bring to the market and how we bring them to the market, that has iterated quite a bit.
Gotcha.
Yeah. Knowing where the crypto is, that seems to be an important one, because you're right. Those early days, like, I don't know if you remember that old commercial where it was like, I forget what company it was, but customer service was just like a fat dude in a shack who kept saying, "This is Peggy," right? And that kind of seemed like the like, so if I want to, is this real? Like, is this how I buy crypto? I'm just, okay, well, here we go.
Yeah. So let's jump back into kind of you starting, Finoa, and kind of the getting funding and that. So it was you and who kind of sitting in an apartment somewhere that came with this idea. Like, what were you doing before, and kind of how did that launch off?
Yeah. So basically, how we got started, and I think I shared a bit of that in the first episode. It's like when Chris, my co-founder, we were basically friends in McKinsey. We never worked together, but we were operating out of the same office. Started around the same time at McKinsey, had the same hamster wheel kind of lifestyle. No time during the week, and then suddenly the weekends had to be very special. So that kind of created our close bonding, and we spent a lot of time those weekends together, and just starting to share investment opportunities in crypto. That started then around 2016 or so, and then we had both a chance to do an MBA sponsored by McKinsey, and for both of us, it was that moment to suddenly have a lot of time at hand, kind of not be in the consulting stress lifestyle, but actually be in a classroom. And I remember very well how I spent a lot of time looking at my laptop, reading about crypto and blockchain, and not taking too much care of the actual MBA course. Somehow, luckily, still passed. But I mean, Finoa started basically there, and I was fully committed. I want to do and build a company in that space. So for me, that was really the time to just sit back and focus and really think and ideate what I want to do. And that's how Chris and I then, more and more came to what Finoa evolved over the last 3 years. Really just sit down. We want to do something in crypto. We feel like this need to do some entrepreneurial activity, and there is this once in a lifetime opportunity to join a very early industry which is going to take off, like web 2.0. So the internet economy. We were just too young, right? I was 10 years old or so, and 13 years old when the bubble burst, and then I just said, well, this is now the next big technological shift, and we are just there, right? We are already active in the space, so let's grab that opportunity, and that's what kind of drove me as well to then to not go back to my previous work after the MBA, but go full in with Finoa.
And did like when you guys set out? I mean, what was the original plan? Like, hey, we want to, we got to get to this benchmark, and then we can get funding, or did the funding topic kind of come in after you guys really took off, and it was like, hey, not only is this working out, but we have outsiders who want to dump money into the company?
Well, we were lucky that we had a bit of family and friends that we could convince to kind of get us started, right? To keep us floating for a bit, and to pay the first engineers to start working on the platform, on the infrastructure, on the product, and then it took us. I mean, we went out in the market around end of 2018, early 2019. It was still in the midst of the crypto winter, and it was incredibly hard to fundraise back in the day, especially pre-product. We had a bit of an let's say maybe MVP there that we could show some wireframes that this is what we want to bring to the customers. No customers signed just yet, and all that was just incredibly hard when we went into the venture capital firms, and they didn't understand crypto at all. They were still kind of led by this narrative in the media which said, it's all just like the next tulip mania, like it's a bubble and there's no underlying value behind it. We were just always thinking that's ridiculous, that technology gives so much opportunity, especially in the financial industry, but even beyond that. And I think we see that already unfolding. So I just couldn't grasp, like, why would they not see the same things that we kind of expected. And I think maybe it was a bit of a disadvantage where that we were fundraising in Europe, because I think the US was at least 2 years ahead, and there was much more understanding, much more buying into the vision of crypto as a new technology and opportunity. And in Europe that wasn't the case, so it was very hard to then fundraise from venture capital. But luckily, after a while of going from venture capital office to venture capital office, we found the right partners to get started.
Just so real quick, what they call anybody that invests in a business, you go to your 3 F's first. It's your friends, your family, and fools are always your initial investors.
I was gonna say he missed one of the F's. He was like, I got friends and family. I was like, and
that's what you said, right? That's what you said. Well, yeah, of course. I mean, it obviously there was a high chance that after 5 months we would come back and say, well, the money is spent and we're out of business.
Sure, yeah.
But luckily we are still in business, still growing.
Yeah, no, absolutely.
Selling potential is hard. Just like, hey, don't ask me for track record, don't ask me for history, but like, look at how bright things could be.
Yeah, yeah. So what was it like walking into those venture cap? I mean, how many did you guys pitch? To before you got that first, someone that was like actually let you in and was like, oh yeah, this might be a good idea.
I don't have the right number on top of my head, but it must have been in 2018, 2019, at least 40, 50 different firms that we spoke to, and and then there was a lot of the ones that ghosted us and never replied, right? So
right, yeah,
I don't have the number, but I mean it was really really hard, and I also remember the times you're just starting to question, is that what you see? Is that really a thing? Is that really happening? And you kind of start questioning your own beliefs. But luckily we I mean, Chris is a fantastic co-founder as well. So whenever he had a bit of a low, I was able to kind of to pull him up, and the other way around. And it's still today. I mean, entrepreneurship is just it's a roller coaster of ups and downs, and we are very complementary. We have our ups and downs never together so far. So whenever the other one needs a bit of a shoulder and whatever, we are really complementary on that. And I think that's also one of the things that is just really important in entrepreneurship in general, is like really pick your founder, your co-founder that you work with, because at the end we spend so much time together that really has to work.
Yeah. Well, you kind of answered my next question, because I was going to ask, like, man, how do you get yourself out of that slump of like, well, I'm going into my 34th meeting, 34th pitch of just getting like the door slammed in my face 33 times in a row, and I'm going to the 30. So, it sounds like you guys just had like a good complementary synergy there. Because I'm sure that gets a little mind numbing to be like, oh yeah, sure, we'll come and present. You're going to say no, but yeah, I'll come and present.
No. Yeah, it gets a bit like that. Yeah, but I mean, if you just strongly believe that sooner or later someone is going to say yes, and you just keep going, and again, luckily we had this early family and friends support that we could, let's say, kind of extend this time a bit to find the right institutional partner. So that was then luckily with a happy ending. But there's a lot of founders that also don't make it to that point, right? We're very close.
So, you don't have to say who your investor was, but kind of that initial series funding, was that somebody that was was tech focused and kind of was already in the space, or is it, and this was one of their bets in the space, or was it somebody that was like, hey, we're not in it, we feel like we're behind, and you guys seem like the fastest horse in the race, and they kind of jumped on? Or did you have to kind of bring that investor along on the tech side, right? Because they had to believe what you believed, right? That same model.
Yeah, well, especially because back in the day there was just very little VC firms that had already a blockchain investment in their portfolio.
Sure.
We had to find, at the end, we found a German fund that at the end had, let's say, one other crypto investment already. So that generally we didn't have to go in and convince them from scratch and explain everything.
Right, about the whole
they
thing
had a starting point. And I think they fully grasp already what Chris and I wanted to build. I actually have to ask them. Maybe not, but I think they very much also believed in the two of us as a team. So I think the investment was rather about, okay, Chris, Henrik, I believe the two of you, with the passion that you bring in here, you're gonna build this, what you're seeing there, and maybe not necessarily based on that they, let's say, fully that we fully kind of checkmark their investment theory just as much, because I don't think they had a clear investment theory in crypto blockchain just yet. That has changed now, of course, 3 years later. So you really needed to find someone that buys because it's very hard if you have to uphill battle, if you have to convince someone of industry which is not there yet, and of you being one player in that industry, right? I mean, obviously, it's a bit easier if that industry has already proven itself. Let's take e-commerce or whatever, and then you just prove you have a great idea with a great team to play a part in that industry. But we always had to kind of do this double uphill battle, and that was just very draining.
Yeah.
Yeah.
Which,
I could see that.
Which, because we had a guest on a couple episodes back, Brett Owens, and his second episode was actually like the anti-raising funding, right? He was all about bootstrapping. He had bootstrapped three startups. So from your standpoint, because one of the things he talked about was like, hey, as soon as you get funding, there's benchmarks, there's pressure, there's all these things. What was your guys' day one you get funding? How did you guys go about to make sure we're treating this money like it's someone else's and we're doing right by the company? What was your priority for getting that money into action? What did you guys set any internal benchmarks of like, hey, we got to start hitting these quotas? What was that like?
Yeah, that's a good point. I mean, at the end, I think it doesn't really matter if you bootstrap yourself or if you raise external capital. I think you always have to kind of, from a founder perspective, that's obviously a bit more easier because I have a substantial equity stake in this company. So I always treat this company as my own, and then also the money that is in the company. It doesn't matter if I brought it in or if it comes from a venture capital firm, because at the end that money is there to be successful with my equity stake, right? And to kind of grow the business. So that's always the ultimate goal, right? Obviously, when you do run like some business models, you set some budgets already, but it's in the very early days. It's just very, very, it's so hypothesis driven, right? It's very hard to, by any means, eat then the reality that unfolds afterwards. But of course, you raise the amount of cash, and if you were just like us going through a very hard time to find cash after all, you also treat it very like a treasure, right? And make sure that you spend it the right way, you hire the right people. Let's say put those stakes that you then have on your balance sheet on the right players, right? And so we kept on doing that, and let's say very very diligent in how to spend the money, and that then also brought us. I mean, it was a small seed round back in the day, just about $2 million US dollars, $2.5 million US dollars, and basically when we then got with that very small amount of money in the whole scheme, got to market, got the traction, then we could also really show a lot of other venture capital firms that this is an investment case, and that made it much easier for us then to show our traction for the Series A, which we then raised about 13 months later.
Okay. So what was it kind of like? We're kind of jumping forward just a little bit, but what was it like for you guys when you kind of had a product that you're like, oh, okay, this can work, and you got the first client, right? The first one that you're like, hey, we're actually going to see revenue. Like, what was that like internally for you guys? Was it like kind of like we feel that we've been vindicated because we've been telling everybody all along this was going to work, or was it just like, hey, we got to do more?
Yeah, actually, I think I shared that last time. I'm not sure, but actually, the first customer that we signed, we were never able to send any invoice because there was just no business after all. But and I spent so much time winning that customer over. But I think there's two very, very important moments that I remember very much. Was signing that first customer, but it didn't turn out to be the best business case. But anyway, signing that customer was a tremendous feeling. And then the second was actually sending the first invoice to a customer. And I mean, back in the day, I'm not exactly sure, but I think it was either me or Chris writing that invoice still manually ourselves, right? Like changing the addressee and then sending it out via email, and then just seeing the first payment coming into our company's bank account. That was just crazy. And then you just start immediately, okay, how do we replicate this? How do we scale this up?
Right,
like how do we send, instead of 2 invoices, how do we send hundreds of invoices, right? Like because you suddenly see, well, if we do that just enough, this is going to scale up, and that was just a great achievement. It just felt very, very great. And then over the last 2.5 years, when you then see more and more customers coming in, more and more, let's say, invoice volumes, and even just the departments that are taking care of invoicing, etc., just growing.
Right.
That's just a very makes you feel very grounded and humble. You remember just 2.5 years back, we were struggling to send the first invoice.
Right. Yeah. I always laugh because you send that first invoice and you're like, you go to Microsoft Word and you type in templates and you go invoice, and it has like, 30,
exactly.
you're like, you find like the right, you're like, oh, that one looks kind of cool, and then you download it and you like type in, it all starts so simple, and now you don't even know what your invoices look like, and they just go out from whatever to, what I mean? It's funny how that whole evolution happens.
And then when someone asks like, hey, why did you do the invoice that way? You're like, I don't know, maybe it's because I had a weird night's sleep and I just clicked on that one. I don't know. Like that's how I picked that one. I was tired and it was the one at the top. Like
absolutely.
So
can very much relate.
Yeah. So you had that first round of the first investment of about $2.5 million, and you said it was about 20 months later where you guys had about a $22 million round of funding, correct?
13 months later.
30 months.
13 months, so about a bit more
13.
than a year.
Yeah, sorry, 20 months. That's way too long. Yeah, 13 months where you guys were able to get roughly 22 million of funding. Was there anything you guys did specifically to say, hey, if we want to look super attractive to future investors, we've got to do business this way?
I mean, well, yes and no, right? You always have a bit of a thought in the back of your head. Okay, so it's like, what are the metrics that we kind of have to achieve and have to show, and the trajectory that you have to show to be an interesting investment case, right? Especially if you are a venture capital funded company, that is just something that you have to consider, think about, right? But is that the main driver how we kind of build the company and build the organization? And like every morning, I don't know, I don't do every morning a stand up with everyone and tell them, okay, these are the 2-3 metrics that we have to do now because the venture capital firms want to see it. That's not the case either, right? But it comes obviously implicitly, and at the same time, you also want to build a company, that at least that's a bit my thinking as well, and I think I'm speaking for my co-founder as well, that also has a trajectory towards being potentially independent in terms of a sustainable business model, a profitable business model, in the not so distant future, right? And that is just also something that is maybe not always the pure venture capital case. They don't really care so much about the profitability anytime soon, right? It's really a pure growth case, and I think a healthy balance between that and having a bit on top of your mind as well. We should think about more or less every dollar, every euro that we spend, and think about the return on investment of every euro and every dollar that we spend, because otherwise you just continue raising money and profitability moves further and further away because you're just not cost efficient either, right? So that's a bit how I think about also then and steering the company and steering also the thought process of every colleague on my team.
Mm-hmm. Yeah. I mean, again, Mark, I think we could ask questions. We could talk for multiple more hours, but kind of on the business, let's kind of jump to the business side and running a business, right? So you had experience, you had this great idea. You're going to start this, exchange and institutional investors, but you hadn't ever run a company before, right? So what were some of those challenges that you guys found at just running a company, right? Whether it be,
hiring
selling
people,
coffee, or but how did you manage that, right? So, and what were kind of the learning curve you had to go through there?
Well, that learning curve never ends, right?
Right.
It's just, I mean, there's just so much more still, and I don't know if you guys read the hard things, the hard thing about hard things from Ben Horowitz, which is all about that, right? Like how the struggle of scaling and growing a business look like and managing a business, and it's a fantastic book. So I mean, obviously in the beginning you kind of just get started, and then it's a small team, and everyone does a bit of everything, and everyone whatever he feels good at or enthusiastic about, just grabs whatever is to do. And then I think, especially we scaled now in the last year from about 20 to 100, 30 people now in just 12 months or so. And with that, the company changes entirely, right? It's just not anymore a company where you just throw a piece of work on the other side of the table, but you really have to set up the structures and the processes, etc., to run those. We hired an entire C-level team as well to support us as founders. And I think one thing that you also learn is, and most of the time you learn it when afterwards, that you should have hired a certain position earlier in the process, because you most of the time only start hiring when the pain is already there and you see it, right? So that is definitely something where I see also the reason why venture capital firms, for example, tend to invest into serial entrepreneurs, because they obviously know, oh, well, those guys have already seen that learning curve quite sometimes. And there's 1,000 things I would do differently the next time, I would be at the same stage. But anyway, at this, in general, that's just a great learning curve. I mean, we are in the middle of that learning curve, because we want to grow this company much further to in business, in size, in team size, of course, and with every evolution step in that company, there's a bit of a process as well from a founder perspective in how to steer the business, and it's just a fantastic opportunity.
Yeah. And what was
Mark?
I was going to say, because you said there's some things that you kind of wish you had hired out, or hired sooner. But what's maybe like one or two of those things where you're like, yeah, if I did this again, I'm for sure getting either this kind of person on staff or getting this kind, this department up and running, much earlier
on. I think it's there's different answers to this, but I think definitely I would earlier hire on the people side, because you also do that when you suddenly figure, oh, now we need so much more hands on deck, and you need to start recruit so many people, and you don't even have a head of people on board yet, so you basically have to start with hiring that one first, and then you can start recruiting on the different aspects. I think that is one position, and I think also on the operations side, especially if you start growing up the team, and just processes that used to work with 20 people, they break sooner or later, right? And also that is something where it might have made sense to bring a senior executive a bit earlier than we did, because I mean, obviously hiring processes take time, and it's a bit different in the US, but in Germany you have a standard 3-month notice term. When someone decides to leave a company, he's bound to that company for another 3 months, right? So that means from the moment we decide to hire someone, and you have the hiring process, then you have the decision, then you have another 3 months. It's always something between 4 to 5 months between the identifying the need and then having someone on board. 5 months, the 3-year-old company is a substantial amount of time, right? So
yeah, that's like a decade
in a very rapidly developing industry too.
Right.
Absolutely.
So that is just, this model might look different.
100%.
Yeah. So kind of, between you and your founder, what was did you guys set out to create a culture inside Finoa? And what, was that kind of intentional, or is it kind of evolve into what it is now, or are you guys still trying to shape that in some form?
No, that's still shaping. And I mean, obviously that's very much founder driven. So we obviously bring a bit our ideas of how we want to work together, and who we want to have, what kind of character as well. But I mean, it's very important, I think, that this comes from the organization itself. So we have a virtue set at Finoa that we want to stick to as a company, and that we hold ourselves accountable against as well. And we keep on iterating that with the team. We go grabbing this. We just did this again. Basically at the end of the first quarter this year, we looked at what did we have on paper before. Is that exactly still what we want to achieve here as a team, as a leadership team, as a company as a whole, or do we need to make some adjustments, iterations, and we'll just learn again that we want to do things a bit differently, and we made quite some changes. So it's a living document and a living scheme at the end for us to work with, and that's how I want to continue to do this. I can obviously be a major part in this and kind of give my guidance and input, but at the end, only works if the team buys into it, accepts it, and keeps forming it together.
Yeah, kind of how did obviously the COVID affect that, right? Because you guys were think you're going to do business this way, and then COVID happens, but you kind of grew through COVID, right? So how did that? It's almost like you were born out of it. So do you think that was a help or a hindrance, or just it was what it was?
I mean, it was what it was. It definitely didn't harm. I mean, COVID started, we were like a team of maybe 8-9 people, right? And then we just grew through COVID, and I'm even happy that we had that experience and not the scale up just, I don't know, the 12 months before COVID, and then we had to change everything again. Because probably the 12 months before COVID, we would have been an on-premise, in-office company. And now through COVID, we became a flexible company. I mean, we are not, I wouldn't say we are fully remote. We still have a headquarter in Berlin, moving to a new headquarter. And it's just a space of collaboration, creative work, and, coming together. But it's completely flexible. Like people come to the office and work in teams because they feel like it. Because they know it's productive and they want to socialize. And I'm very happy about that outcome. How we grew in that space makes us very flexible and dynamic as an organization, and that also again sets us probably apart from players that maybe grew big before, and that makes a lot of the incumbents in the traditional financial system. They're still struggling, to kind of cope with their processes, and it wasn't a hinderer at all. It was more a great opportunity that we had as a company to grow during the pandemic.
Yeah, that's great. Yeah, so I mean, kind of where do you if you're looking at your the crystal ball, where do you see kind of the crypto space going? And obviously, Finoa is going trying to fill a huge void there on the institutional side, but kind of where do you see this going? Give your predictions.
That's the $1 million question, right? I was almost afraid that you're going to ask me what's the Bitcoin.
I was going to say we're gonna save this and send it to you in 5 years to see if you're right.
Yeah, no, that's it. Yeah,
exactly. No, I mean, in general, what do I believe? I think that DeFi crypto is the new financial layer, right? I mean, the financial industry will be built on that technology. For me, it's not going to be parallel. It's not going to converge old and new. No, it's going to be entirely shifting to crypto. Any asset that we trade will be traded on crypto blockchain rails. It's a different question if the user actually sees that shift and feels that shift in the user experience, but in the back end and the core, everything will be moving to that tech stack, to that infrastructure. It's definitely, we will see a consolidation of different, let's say, platforms, protocols. So, because at the moment there's so many Ethereum, the next Ethereum, you hear that all the time, right? Like there will be just a consolidation towards some standards. It's not going to be one platform. It's probably going to be a set of platforms for different use cases and for different, at the end, for different token economics in a sense. But it will probably go down maybe to 5 to 15 different platforms, not necessarily thousands of different platforms that these use cases will be built upon. And I think what is also about to happen, and it will happen for sure in the next 2-3 years, is that we see, be it a digital dollar, digital euro, and in somewhat as a form of a stable coin that is again on the same infrastructure, because obviously right now it's still, there's a break in the user experience, a break in the between the two worlds. If you have to bring fiat money into crypto, right? It's just always you have to go through some conversion gateway that's costly. It takes time, and you have the incredibly fast crypto ecosystem, and then the slow T-3 banking infrastructure, right? And that just doesn't fit. So with a stable coin on the same rails, be it central bank backed or not. That's a whole different episode that we could discuss, but
Right.
there's going to be the stable coin will be sitting in every wallet on every phone, and you would use it for everything when you want to invest in and out of different assets. You will go back not to fiat in the traditional sense, but to a stable coin representing maybe fiat in the traditional sense. But that will just facilitate the user experience and facilitate the interaction with DeFi, with international transactions so much, and it's just bound to happen.
Yeah. So I promise this will be my last question on the crypto stack, because again we could talk about this for a long time. But as far as the transactions go, and being able to, like do transact property ownership, right? And some of those you said those were kind of like slow integrations, or doing international trade, right? And having that common contract. Why do you think that has taken? It kind of seemed like it was kind of ramping up, and then it kind of fell off again. And how long do you think it'll take before that really? What do you think the holdup is there for that becoming a real thing, where that you can have that, don't need all those intermediaries?
I think for what I can see, at least from our standpoint, and also from the European context and jurisdiction, is just that the technology to do tokenized asset transfers and tokenized asset registries, and it's all there. It exists.
Sure.
It's just a matter of the lawmakers and the regulation to kind of allow it in a certain sense, and with that also paving the way to become mainstream. And that, at least in the European context, there were billions of dollars of pipeline of potential tokenization projects that I've seen on my table, basically, but that never really unfolded into reality because they just couldn't get it to market. They couldn't get it to distribution, either because of regulatory concerns or because the market didn't buy into it, because maybe also the infrastructure wasn't quite there yet, right? And just investing into the same asset just because it's a token, if it doesn't create additional yield or is more efficient, is cheaper, whatever, that also is not a means to an end, right? So there has to be this additional benefit to it. And if it's just incredibly cumbersome for technological or regulatory reasons, it's just not happening. And I think that's true also for a lot of other jurisdictions where I'm not so familiar with, but I think that's the core driver.
Okay, awesome. Okay, Mark, I can ask 1,000 more, but we can cut off.
I actually think that's a good place to kind of wrap up here. Real quick, where can people go to follow you? How your company's developing, and time test your predictions on crypto there, because we are going to be judging you.
Yeah.
No, happy to. So, visit our website at finoa.io, so FINOA.io. Visit us on Twitter. I think our handle is Finoa_banking. And there's different Medium blogs as well that we post. We have a blog on our own website as well, where we publish a lot of thought pieces, also a lot of we are not an investment advisor either, so I can do that disclaimer here myself. But we help to understand the ecosystem. We help to understand different asset classes in the ecosystem, different yield mechanisms in the ecosystem. And then when you have made your decision, we are obviously able to help you with the infrastructure, with the platform, to manage the assets. And so happy to get into the conversation.
Yeah,
perfect. Well, Henrik, just from my point of view, what you're doing is genius, because the industry needed that mechanism, right, to connect the old and the new and be able to. Anyways, a long conversation, but yeah, I think you guys hit a sweet spot right there in the crypto, the tokenization world, which is very cool.
Yeah.
Perfect. Excited for what you guys are doing.
And now we'll head into the speed round. All right, here we go.
Here we go.
So last few questions, speed round. So you mentioned The Hard Thing About Hard Things. What is another book that you think every entrepreneur should read?
I think it's Think and Grow Rich. It's, what is it, from 1919 or so, if I'm not mistaken.
Yeah. Mm-hmm.
And read it with a bit of a grain of salt, because obviously it's 100 years later, and not everything that you see there is still politically correct, I would even say. But it's just very interesting book and interesting thought process, and I really enjoyed reading it.
Awesome.
I think I'm gonna like create a list, and we're gonna tally like all the common ones. And as soon as it like hits five guests have recommended this book, we're gonna just have to like blast it out or something.
Yeah. Okay, so if you're giving advice to another entrepreneur that's getting ready to do some seed, trying to go for a seed round or an investment or venture capital, what is one of the most important thing or piece of advice you would give them?
Perseverance, or how you call that in English?
Perseverance, yeah, okay, yeah.
I think
knock on that 34th door.
Yeah, keep going.
Yeah, absolutely. Okay, perfect.
Okay, so if you were to name a crypto coin yourself, what are you naming
it? That's a fantastic one. I mean, maybe we should think about a Finoa coin, right?
Obviously,
to bring that to market, and keep building on our brand.
True entrepreneur. He puts his company in there, not his own name. Like anyone else would be like the Mark coin, duh.
Yeah. All right, so you're going on a week-long vacation, all expenses paid, money's really no object. Who are you going with? It doesn't have to be a loved one. And where are you going?
Right, it's gonna be my wife, and we would go to the Alps, to the Italian Alps, to just rest and eat Italian food, but having mountains in your back, and nice. I think that would be my preferred spot.
Now, is that because she's going to listen to this podcast? Do we need to do hey, if she doesn't listen to the podcast? I really hope so.
But are you going to the Italian Alps in the winter or in the summer? I mean, they're equally beautiful, just different.
It doesn't matter. It's always worth a trip. But yeah, either you go skiing or you go like mountain biking.
Yeah. Okay. Perfect. I love that. So if Henrik's wife is listening, he's taking you to the Alps. That's your next vacation. There you go.
Yeah. Start calculating how many Bitcoin it's going to cost. So
yeah.
Hopefully just a fraction of a Bitcoin.
Yeah. The fewer the coins, the better.
Yeah. Awesome. Well, Henrik, thanks so much for being on, man. We really appreciate it. This was awesome.
Yeah, thank you very much. Very happy to be here. It was a great conversation.
Perfect. Thank you. And real quick, so just a follow-up disclaimer, nothing we say here can or should be taken as tax, legal, or financial advice. Plenty of interesting information here. Please, before doing anything, seek professional counsel. And thank you very much for listening. And we will, excited for the next episode.
Yeah, if you want to get a hold of Henrik, all the stuff will be in the show notes. So make sure you click on those and reach out if you have any questions, especially big institutions. Hey, Pershing, if you're listening.
Awesome. Perfect. Thank you very much.